The Applied Digital Corp ticker is flashing a live price of $24.99, currently trading up $1.90, which translates to a massive intraday surge of 8.23%. While the broader indices are fighting for direction, this stock is decoupling completely, ripping higher on volume that is already pacing double its 30-day average. If you are watching this ticker on your Fidelity mobile app or tracking the momentum through your Interactive Brokers trading platform, you are witnessing a classic dislocation between price action and headline sentiment. The expectation entering this morning's session was hesitancy. The headlines have been dominated by the company's massive capital raise, specifically the pricing of $2.35 billion in senior secured notes. Typically, when a company the size of Applied Digital announces billions in new debt, the knee-jerk reaction from the retail crowd on Robinhood stock trading forums is fear. The assumption is always that the balance sheet is being stressed or that equity dilution is right around the corner. That is the expectation. Debt equals risk, and risk usually means a sell-off. But the reality playing out on the tape right now is diametrically opposed to that fear. The market is bidding this stock up over 8%, not despite the debt, but because of it. This is the nuance that separates the casual observer from the institutional analyst. The reality is that this $2.35 billion influx effectively fully funds their growth capital expenditures for the next massive phase of their build-out without forcing them to sell undervalued stock. By securing this funding, they have essentially de-risked the execution of their massive backlog. The market realizes that the funding overhang, the worry about how they would pay for all these new data centers, is gone. The check has cleared, the construction can accelerate, and the revenue timeline is now locked in. This is why you are seeing green candles stacking up on the intraday chart, while the bears who shorted the news are being forced to cover at $25. When you look at the order flow today, it is not just retail speculation. We are seeing large block orders executing above the volume-weighted average price, suggesting that funds are accumulating aggressively. If you use Schwab Intelligent Portfolios or manage your own individual brokerage account, you know that seeing this kind of price acceptance above a psychological resistance level like $24 is significant. It signals that the market is beginning to price in the next 2 years of cash flow today. The chatter on investing sites often misses the structural shift happening here. Most people still categorize Applied Digital in the same mental bucket as Bitcoin miners, largely due to its history. They expect the stock to correlate with the price of crypto assets. If Bitcoin drops, they expect Applied Digital to drop. However, the reality is that Applied Digital has effectively mutated into a pure-play digital infrastructure asset for high-performance computing, or HPC. The stock is no longer tracking crypto, it is tracking the demand for compute capacity from the likes of Nvidia and the hyperscalers. Speaking of Nvidia stock, the fact that Nvidia holds a direct stake in Applied Digital is often overlooked by the algorithm-driven news feeds, but it is the cornerstone of the bullish thesis here. When the company that manufactures the chips invests in the company that builds the houses for those chips, you have to pay attention. This isn't just about renting rack space. It is about providing the specialized, liquid-cooled environments that the next generation of Blackwell chips require. The expectation is that all data centers are created equal. The reality is that 90% of existing legacy data centers simply cannot handle the power density required by modern AI clusters. Applied Digital is building the facilities that can, and that scarcity is what is driving the premium you are seeing in the stock price today. Let's look deeper at the chart dynamics we are seeing right now. The stock opened strong and dipped briefly in the first 15 minutes of trading, likely flushing out weak hands who were nervous about the debt headlines. But that dip was bought up ferociously, creating a V-shaped recovery on the 1-minute time frame that propelled the price through the $23.50 level. Now sitting just under $25, we are at a critical inflection point. If you are engaging in self-investing or using SoFi active investing tools, you need to watch the $25 level closely. This is a psychological barrier. A clean break and a 4-hour candle close above $25 could trigger a gamma squeeze where options market makers are forced to buy shares to hedge their exposure, adding fuel to this fire. It is fascinating to compare the sentiment around Applied Digital to something like Tesla stock or Apple stock. With Tesla, the narrative is always about the consumer. How many cars did they deliver? With Apple, it's about iPhone units. But with Applied Digital, the customer is the infrastructure itself. The demand is invisible to the average consumer, but it is massive. We are talking about hundreds of megawatts of capacity being leased out before the building is even finished. This pre-leasing activity is the metric that matters. The expectation is that a company building infrastructure takes on huge risk that tenants won't show up. The reality for Applied Digital is that the tenants are lining up and signing 15-year leases before the cement is even dry. This contract structure turns what looks like a volatile tech stock into something that behaves more like a utility company with high growth characteristics. If you are looking for investment help or browsing Fidelity ETFs, you might notice that infrastructure funds are starting to overweight these types of pick and shovel plays. They are moving away from the chip designers and towards the power and cooling providers. This rotation is subtle, but it is happening. The institutional volume we are seeing today in Applied Digital is likely part of that broader sector rotation. Fund managers are asking themselves, we own enough Nvidia stock, we own enough Microsoft. Where is the bottleneck? The bottleneck is power and cooling. Applied Digital solves that. That is why, despite the high interest rate on the notes they just issued, the equity is rallying. The market is doing the math and realizing that paying 9% interest on debt is cheap compared to the 40% internal rate of return they can generate on these AI cloud facilities. I want you to pause for a second and analyze your own thesis if you are holding this. Comment below how many shares of Applied Digital Corp you currently hold and what your average cost basis is. Are you green on this move, or are you still waiting for higher levels? It's always interesting to see where the retail sentiment is positioned versus the institutional flow. Continuing with the analysis of today's price action, we have to talk about the short interest factor. Applied Digital has historically carried a high short interest because skeptics doubted their ability to pivot from crypto to HPC. They looked at the balance sheet, saw the capital intensity, and bet against the execution. Today's move is painful for those shorts. When a stock rises 8% on news that was supposed to be bad, taking on debt, it creates a psychological break for the bears. They start to question their thesis. If the stock won't go down on debt issuance, what will make it go down? This realization often leads to capitulation, where short sellers buy back stock just to get out of the pain, which drives the price even higher. This feedback loop is likely contributing to the sustained bid we are seeing at the $24.99 mark. Let's widen the lens to the macroeconomic backdrop. We are operating in an environment where interest rates are a constant topic of conversation on every investment site from SoFi Invest to the Robinhood app. The expectation is that high rates hurt capital-intensive businesses like data centers, and that is generally true. However, the reality is that the demand for AI compute is so inelastic, meaning companies need it regardless of the price, that Applied Digital can pass those costs on to their tenants. When you have a customer like a hyperscaler who is in an arms race for dominance, they are not going to haggle over a few percentage points on a lease. They need the power, and they need it now. This pricing power is the hidden asset on Applied Digital's balance sheet. It allows them to maintain margins even in a high cost of capital environment. Furthermore, we need to discuss the utility aspect. Applied Digital isn't just building servers, they are engaging in complex power purchase agreements with utility companies. They are securing hundreds of megawatts of power in North Dakota and other regions. In a world where the U.S. power grid is becoming increasingly strained, holding the rights to 500 megawatts of power is like holding gold. It's a finite resource. The market is starting to value Applied Digital not just on its cash flow, but on its power bank. If you are using Interactive Brokers trading tools to look at the energy sector, you see this trend everywhere. Power is the new oil, and Applied Digital has secured the rights to a lot of it. There is also a comparison to be made with how retail traders approach Robinhood crypto versus Robinhood investments in stocks like this. In crypto, you are often betting on a network effect or a currency adoption. Here, you are betting on physical physics. You are betting on the fact that high-performance chips generate immense heat and require immense power. There is no speculation about that. It is a physical reality. Applied Digital's proprietary cooling designs are a direct response to this physical constraint. While other companies are trying to retrofit old warehouses, Applied Digital is building purpose-built facilities that are designed from the ground up